Botswana.
Bots is okay. It's a bit cooler now as we are approaching winter, so it's better than when it's hot.
Okay. Victor, how is Harare? I guess you're in Harare.
Yeah, Harare is well.
And the crocodile is okay.
Yeah.
Okay.
And it's cold today. It's cold. Yeah.
Yeah, even Lusaka it's a bit cold. Okay, so let's look at this question. It is on V structures. Then I'll send another question on, I think I'll still send a V structured question for you to just work it out. The question reads, Bravo, a public limited company, operates in the manufacturing sector. The draft statement of financial position at the 1st December 2017 as follows. So we have the property, plant and equipment. We have the investment in GAL. And we also have the investment in Russell, meaning that GAL bought shares in Russell and Bravo bought shares in GAL. At any given time, it is just this balance sheet needs to balance because we know that we have the years. And we have the liabilities. So in short, when you're looking at the balance sheet, and this is how I always want to look at it, is that what you're seeing here, this is basically financed by more of a cash flow. So what is financing? What financed these assets? So what financed the assets? Those equity and liabilities. So the notes reads on, that is on Bravo business. Bravo bought 75% equity shares in GAL on 1st January 2017 for a cash consideration of 74 million kwacha. At acquisition, the retained earnings were 50 million kwacha, and the fair value of the NCI was 35 million kwacha. Notes on GAL business transactions with Russell. GAL bought 65% equity shares in Russell on 1st August 2017 for a cash consideration of 55 million kwacha. At acquisition, the retained earnings were 30 million kwacha. On 1st August 2017, the fair value of NCI was 33 million kwacha. So from what we are seeing here is that a GAL bought shares after it was officially acquired by Bravo. It was acquired on 1st January 2017, and it also acquired 65% of the shares in Russell on 1st August 2017. So meaning that the relationship between Bravo and Russell, if you have 65%, 0.65% times 0.75%, this 48.75% would actually be part of equity. Then the NCI will come in with 51.25%. So the first thing that we start with is to prepare the group structure. It's just about a month or so. I'd already done the model. So the equity shares in Bravo, or which Bravo acquired in Gale, it was 75%, so put 75%. So meaning that the NCI was 25%. Then Gao bought 65% of the shares in Russell. So meaning that the NCI was at 5%. That is the relationship between Gao and Russell. But because Bravo is the one who is consolidating, is the parent company to the subsidiary and is the grandfather to the sub-subsidiary, in this case, Russell. The effective rate in Russell, like I had already explained, it would be 48.75%. Whereas for the NCI, we'll go into, it will be 51.25%. So the game plan here is very easy. Like I said, the foundation, you have a very strong foundation on knowing all the 5 or 6 steps. So the first thing that we'll have to do is to find the NCI, to find the net assets in Gale. Once we get that, which is pretty easy, we'll then go to finding the net assets in Russell. Same concept, same principles. We need these 2 computations to help us in finding goodwill, which will be in working 3. Even in working 3, we'll first find the goodwill in Gale, find the goodwill in the sub-subsidiary. And then we'll remove any seemingly double entry or end transaction that we think would actually be counted twice if we let it there. Once we are done with the goodwill, no, on goodwill, we'll not even do that. It's pretty easy. It's on the NCI where we have to try and remove certain components, which we think are coming in because of double entry, double counting, sorry. Then we'll get our retained earnings, which is no brainer at all because it is straightforward. Are we okay up to this level?
Yes, we're okay.
Yes, you're okay.
Mm-hmm. So we'll then now find the net assets in Gao. This is basically connected to the balance sheet because this is at report date. So at report date, we have a 50, which is the share capital, and we have the 75, which is retained earnings. So the only thing that we need to get is at acquisition. What was the share capital at acquisition? We know that the share capital at acquisition, because there hasn't been changes in shareholdings, was 50. But then we also need to know what were the retained earnings at acquisition. If we do not have that number, obviously examiner will be able to give us the total net assets at acquisition, which we are going to plug into our small model. So we are told here, Bravo bought 5% equity shares in Gale on 1st January 2017 for a cash consideration of 74 million. At acquisition, the retained earnings were 50 and the fair value of NCI was 35 million. So what was the net assets in the subsidiary at the time we acquired, at the time Bravo was acquiring this particular entity? Hello, Victor, look.
Net assets.
Yes, what was the net assets? How much was the net assets at acquisition?
Is it not 100?
It was 100 because you have the 50 that
50,
is coming
yeah.
in as share capital, and the retained earnings, it was only 50.
50, yeah.
So giving us
100.
100. So we have our 100 here. So the retained earnings at post acquisition was 25,000. Agreed? Is there any
Yes.
controversy?
No.
No.
Or you want to riot? Can you violently riot? Then secondly, now we do the net assets in Russell. Like I've always said, once you get to understand the methodology of this thing, it becomes so methodical. It's building blocks. You're just building a house or a plane. So we go now to the net assets in the Russell. We know that at report date, these are the numbers we have. We have the 40 share capital, we have the retained earnings, which is 45, and it's connected properly to our balance sheet. So let's just hear what is there. We are told, again, notes on GAO business transactions with Russell. We are told GAO bought 65% equity shares in Russell on 1st August 2017 for a cash consideration of 55 million kwacha. At acquisition, the retained earnings were 30 million kwacha. So we get back there. Here it was 30 million kwacha. So we have this amount like this, giving us the retained earnings of 15, the post-acquisition of 15 million kwacha. I think this is what I've interpreted here. At acquisition, retained earnings were 30, so it's pretty easy. So now we have these two net assets in the subsidiary and the sub-subsidiary. So then we move now to Goodwill. Same principle. But at Goodwill, let me just explain what we are going to do there. We have no problem in computing Goodwill for the subsidiary, or in the subsidiary, so to say, the transaction between the parent company and the subsidiary. Where we'll need to do a bit of some tweaking will be on the relationship between the parent company and the sub-subsidiary. So maybe I'll need your indulgence on this one. If this statement, let me just read it out. GAO bought 65% equity shares in Russell on 1st August 2017 for a cash consideration of 55 million. So if we are calculating Goodwill, if we are trying to calculate the fair value consideration, how much are we going to take there? Is it still 55 million? If not, what should we do?
No, I think we'll take 75% of over the 65 times 55.
Yes. So what we are actually going to do, and that's just wash out, because Bravo has 5% interest in GAO, right? And GAO spent 55 million kwacha. If we take 55 million kwacha as fair value consideration, we would have assumed that Bravo has 100% interest in GAO, in Russell, isn't it?
Yes.
Yes.
But then we know that it's just 75%. What we're going to do, only get 75% of the cash consideration. That is what we're going to consider as ours. The rest, we're going to leave it as part of the NCI and all these other things. The logic is okay, isn't it? We all understand that.
Yes.
Mm-hmm. So first, we start with the GAO. Here we have no problem in terms of the fair value, consideration, because here basically what we are getting the whole 100% fair value, because this is what Bravo, and it's real, this is what Bravo spent in GAO. So go this side and say, and get the 74 million, because this is what Bravo spent anyway. Then for the NCI, we know where to get the number, the NCI at acquisition. Where do we get the number, the NCI at acquisition? Or actually get it from here. NCI at acquisition. So we have this number here times
25%.
Times 25%. Where do you get it?
Okay.
Yeah. So here it shows that we had, because the net assets, we have that. So it shows that we had a negative goodwill. Then we'll come this side on the NCI. On this goodwill.
On that, if I could ask on that, in this question, are we not given the NCI at acquisition?
Have we been given? Let me just check. I'm sorry.
We are
Let me just
given.
check. Oh, it's there. Okay. At acquisition, the retained earnings were 50 million, and the fair value of NCI was 35 million. Okay. Okay, we're given that. So thanks for that. That 5,000, huh? Isn't it?
Yes.
Yes.
Mm-hmm. Then this side as well we are given, right?
Mm-hmm.
Yes.
Which is 33. On 1st August 2017, the fair value of NCI was 33.
33.
Okay, thanks for that. Mm-hmm. So giving us the total goodwill of 26,000. Okay. Then now we move on. From there, there will be some people who will join us, but there will be. So from the NCI, hello, good evening. Good evening. Let's first just greet our visitor.
Hi, evening, Fitzpatrick.
Yeah, I'm okay. Thank you. I'm just having a short class, so if you don't mind, you can just wait for your colleagues to come in. Then we'll start later once I'm done.
Okay, not a problem. Thank you.
Thank you.
Because on the goodwill, are we getting the entire goodwill, or do we calculate the entire, or when we are now putting it in our statement of financial position, then we'll do the percentage.
No. The goodwill is goodwill. We have already computed the goodwill.
Mhm.
We have found the goodwill between Bravo and the girl, and we have also found that goodwill in Russell.
My question is on the goodwill in Russell. The fair
In
value
Russell, yeah.
consideration, how did we calculate it?
The fair value consideration.
The
We
54,000.
got the 75%. 75% because this is what Bravo has. Bravo has 75% interest in GAL. So if you go back to the question, the question here, it gives us how much?
Okay.
Cash consideration of 55 million.
55 million.
What we're actually saying is 55 times 0.75%.
Mhm.
Oh, it's 41.25. What did I do?
You took 72.
Where did I get the 72?
You used 72.
It's supposed to be how much? 55, huh?
Yeah,
It's 75% of 55.
55 million.
55, yeah. Okay. So it is 55,000 times. Oh, thanks. I didn't even see that. Times 75. Okay. It's okay now?
Mm.
Okay. Then total goodwill is 13,250. Victor Loke, is it okay?
Yeah, it's
Yeah, it's
okay
okay.
on my side. Okay.
Okay, thank you. So then now we go to the NCI. Few things to do here, which have already been done, I think, yes. So we have on the NCI, because it's all connected, we have at acquisition, which is 35 and 33,000. Here you have no problem, right?
Mhm.
Then at acquisition, what you're picking, you are just picking from working
The
two.
questions. Working two, yeah.
Yes. So you're picking the NCI at acquisition, which is 35 and 33.
That's okay.
So let me then just explain something again. On the NCI. So on the NCI, we'll have something like this first. We'll have for the subsidiary and for the sub-subsidiary. So we'll have at acquisition, which obviously we are going to pick from working three, Goodwill. Then we have the one that comes in at post-acquisition. So on this one, we're actually going to pick from working two here. But there, we'll use the effective rate.
Which is 65 by 75%.
Yes.
Okay.
So we'll use the effective rate. Here, it's the usual. Then, this is the adjustment that we're going to make here. So it will be the the investment that SS made, that the subsidiary made in SS times the NCI under S. The NCI that you calculate on S. So meaning that this S, this is why people get confused. This S, you are looking at the parent company to the subsidiary. So any NCI that you compute here, the percentage, this is what will come and sit there. So you just check in the balance sheet that what was the investment in SS by the subsidiary, then you multiply by the NCI coming from the one that is direct from the parent to the subsidiary. This number, when you get this number, you have to adjust because it is assumed that there is some double counting that has already been done. So you need to actually remove that. And sometimes coincidentally, what happens, you'll see the numbers. Coincidentally, even when you do computations, you'll find that this number, you have actually computed it as somewhere. It's basically 13,750.
I'm fine. Can I talk to you later? I'm in a lecture.
Mm-hmm. So let's go the other side, then do this. So here it will be Gauss cost of investment in Russell. So what you do here, you have, this is the cost, the investment cost by Gauss in Russell. So now you have to make an adjustment. So that is the adjustment that you make where you're going to say 55 times your group structure. In this case, your group structure here is 8.5, giving you this 13,750, which you need to remove from your computation. So that is the only trick that you are going to have on the group structures.
So it's the NCI portion.
Siamo, is it Siamo?
Yeah, Siamo. Afternoon, man.
Afternoon, Siamo. How are you?
I'm good. How are you?
I'm fine. You can just relax a bit. We'll be done soon. Just relax. Don't pull out. Just relax. We're almost done.
All right.
Mm-hmm. Okay, thank you. Luke, you're asking a question. Were you asking?
It was me. I was asking, so it's the investment of the subsidiary into the subsidiary and then the NCI portion of it.
Yes, the NCI portion
of the investment.
Mm-hmm. Mm-hmm.
Okay.
Right. That is what you're actually removing. Mm-hmm. Okay. So this is basically, this is the only trick that you would get. If you get it right in the exam, you would actually get maybe a 1.5 mark, just this part. Mm-hmm. But what you're doing is that you're just removing your double counting effect. Okay. And mostly when you check on this number, you'll see that this number, you must have seen it somewhere. It always coincides. That is 750. Did I see it?
Total Goodwill. Ah, is it the one? That's 18.
Oh, but it just coincides, but don't look at it in that way. Okay. So then now you go to the group retained earnings. Group retained earnings, we know that from the parent company, we get 100%. That is what we do. From the subsidiary, we'll only look at the post-acquisition, which in this case will be the computations in working 2 times the rate. So if we come here, it will be this number times 0.75%, giving us 18,750. Then here, we'll have this times the effective rate. The effective rate, which is 48.750, which is somewhere there. Let's just check. I've gotten it right. Yeah. So that is what you get from here, which is the 15,000 times or 15 million times the effective rate. The effective rate is 48.75. So on group retained earnings, ignore this part. This is 48.75. So in short here, you only get the effective rate. Okay, is it okay?
Yes, it's okay. That's okay.
So then you come to the balance sheet, you do your consolidation, which is now easy because you're just picking these numbers. Retained earnings, NCI. If anything from here, you're actually picking about 3. Is it 3 numbers that you normally pick? You pick the goodwill, you pick your group retained earnings, you pick your NCI. So you have your working 3, working 5, and working 4, and that's it. Then your balance sheet balances. So what I'm going to do, Victor and Luke, I'll send, I think just after meeting the team, I'll send another question that you can just work on. I hope you'll be able to give me the manuscript later.
All right, that's okay. Send. Can you also send the audio, the video?
You should subscribe to my YouTube account. It was sent.
Oh, it's there. I subscribed.
Yeah, subscribe and also hit on the notification button so that whatever I send, whether it's in financial modeling, it's in the advanced financial reporting, you have access to it.
Oh, okay.
But I'll still send you the thing, the link. But subscribe. I want to see you to hitting the notification button.
All right, that's okay.
So obviously, this is you're checking out the time. You don't just leave the hotel without going to the reception. Even if you went there with someone who is not your wife, you need to go through the reception so that you walk the walk of shame. So please, can you check out?
Yeah, fully understood. I think with a bit of exercise, I'll grasp the concept, but I think only the tricky thing is on the NCI, computations, but I think I've grasped the concept.
So on the NCI, always remember that the NCI that you're computing between the parent company and the subsidiary, you actually pick the cost of investment in the subsidiary, then you multiply it by your NCI rate, which is between the parent company and the subsidiary. Once you get that trick, then that's it. Look, also check out.
Thank you, Coach.
Hotel. Yeah.
I think it's well explained and understood. And like Victor said, I think with more practice, I think we can hone our skills and be able to fully grasp the basics. But so far, so good.
Sure. So thank you so much. see you tomorrow, but I'll send a question that you can start working on. Practicing, you don't learn these things by chance, it is through continuous practicing. Thank you so much and
Okay.
bye-bye.
It's okay. Thank you.
Thank you,
Thank you.
Coach.
Thanks.
Okay, bye.